Getting ready. First live stream of the week. You know what? Should have done one earlier today. That would have been so cool. Dang it. Have to think of that next time. Thank you so much for joining me. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. This is my live stream. We talk about personal finance, investing, and all things personal finance. We strive to put the personal back into personal finance. If you have any questions while we're going through the show, please ask me in the comments. I love hearing from you. Words of wisdom, words of encouragement are always appreciated. Today, I want to talk to you about what happened in the market today, the big recovery, about buying the dips, picking through the rubble, how best to go about it according to me. Okay, so that's what we're going to talk about, and we're going to roll a quick intro. So stick with me. Going to be a good show, and here we go. Okay, thank you so much for joining me. We're just getting started. I want to talk to you about what to do with this crazy market, specifically picking through the rubble. What should you be buying? Should you buy? Should you wait? Should you do nothing? There's a couple of ways to think about this, and it depends on what your goals are, of course. You know, those things we always say, financial goals, risk tolerance, time horizon. That's it's important. I think, excuse me, I do have a hell of a sniffle. I just got back. I just had a COVID and flu test literally about 20 minutes ago. I just walked back to my office, negative on both. So I just have a standard garden variety cold that has just been knocking me on my butt. In any event, hit me up with questions while we're watching Words of Wisdom, Words of Encouragement. They're always appreciated. I want to talk to you about how to think about buying through the rubble. Are you a stock picker? Are you saving for retirement? Are you just looking to trade, get in, get out? That's what we're going to talk about. So first, let's just take a quick look at how, a couple of the big things today, some of the big news in the markets. And I don't want you to miss anything. Okay. So here we go. Let's do a quick share screen. I'll pop myself up in the corner there. Let me get rid of the social media icons over there. Okay, that's a little bit better. We're on the home page, but I don't actually want to be on the home page. Okay, let's get to U.S. markets. Okay, can you see that? Okay, can I make this a little bit bigger? Yeah, it's better. All right. So the Dow is only down 162 points, down. I don't know, was it down 400, 500 points earlier in the day? You see, I don't actually sit here and stare with computer face like this, all day at the market. I'm actually working and helping people achieve financial goals, helping people avoid making mistakes, keeping people from doing hasty things with their money at the worst possible time. We don't want to do that. And sometimes I have to do that for myself. I see markets going up, markets going down, and I realize, this is part of it. I've gotten good at removing emotion from the equation. Look, I've been doing this for over 30 years. You cannot do what I do for as long as I have done this without, literally checking your emotions and your ego at the door. This is just volatility. It doesn't really bother me. And as a result, I don't have a need or a desire. It just doesn't mean anything. I don't follow the market on a minute-to-minute basis. I mean, I look a couple of times, but my clients' accounts are set. We're making changes along the way gradually, and you don't want to wait for a massive down day to make a big change, because then you're just overreacting. Like, oh, I've just left my account alone. I haven't rebalanced. I haven't sold, bought. Taking a tax loss, whatever. But now the market's down a lot. You're like, oh, I better do something now. We humans are great at making decisions at the worst possible time. And usually we wait until the anxiety builds up and then we have an all-out panic reaction. We don't do that here. You don't do that. And that's what I want to do. That's part of the show. But the Nasdaq was down over about 3%, maybe a little bit more, and it had a huge turnaround to be up 7%. So, I'm sorry, up 7 points, up a fraction of a percent. It was up just about 7 points. Now you might think, "Oh, big deal. The Nasdaq was up 7 points. It's nothing." Compared to how it was earlier in the day, this is a major victory, up 6 points. The Dow only down 162 points. Nasdaq, I'm sorry, S&P down only 6.7 points. Okay, those are victories, and this is something we'll talk more about. The 10-year yield was actually down on the day after breaking 1.8% earlier today, this morning. The VIX remarkably closed under 20. That is remarkable, and it just seems like it was much higher today, but a sense of calm really came over the market in like the last half hour of trading. It's a good thing. Gives you a little bit of time to breathe and to think. Okay. Russell 2000 was off 8 points. No big deal. So let's get into the heart of the matter. Okay. I see a few of you out there. By the way, if you're watching this, thank you. So if you're watching while you're watching this, if you'd like me to see you and for a shout out, just hit the like button, the applause button, or the light bulb button, or heart, depending on what platform you're watching from. I'm also streaming to into Twitter, YouTube, Facebook, and LinkedIn. Josh is out there. Good to see you. Thank you for the emojis as always, buddy. Peter is out there. Hey, Mitch, Happy New Year to you and the family. Hey, thank you very much, Peter, and same to you, my friend. So, but if while you're watching, give it a thumbs up, and I could see who's out there. I can't tell who's watching it. I see people are watching. I can't see you. Like a friend of mine the other day said, "Can you tell if I'm watching it? If I don't like it, no, I cannot. But if you give it a thumbs up, I can." So, we've been talking about the last week or so how the tech wreck of the year 2000, the bear market of 2000, how the Nasdaq went down 80% and how gut wrenching it was. It wasn't like a one day wonder or a bad week. It was over 3 years. Okay. From early for like March of 2000 through March of 2003. So actually almost exactly 3 years to the day that the market went from peak to trough. And even though it troughed in March of 03, by that point, nobody wanted to buy tech. Nobody wanted to own anything in tech. In fact, Google didn't go till 04. Facebook didn't go public till 2012. And it was gut wrenching. And at that point, people had given up on tech, didn't want to buy the dips anymore. And tech became under owned. And as a result, it had done quite well after that. But people were afraid of it. People binged on it. So that is what that is all about. Okay, Peter, thank you for the thumbs up. Thank you, all of you, for watching. So, but going through that time and then going through the Great Recession of 0809, I remember one time during the Great Recession, the market, the Dow was down like 200 points, and everybody was celebrating like that was a good day, being down 200 points, and that's when 200 points meant something because the Dow was under 10,000 at the time. So the fact that the fact that the Nasdaq was up 6 points and people are celebrating, that tells you how rough it's been. That 6 points up on the Nasdaq is a really good day. I don't think well, it's easy to say the volatility is not over because there's always going to be periods of volatility. But this current bout of volatility, I don't think ends so soon. It started with the Friday after Thanksgiving. It has continued to do so. That Friday after Thanksgiving, that was the day when the Fed got hawkish. And I think what's going on now, if you want to know what's really setting the market off, the Fed went from so incredibly easy, so nonchalant about inflation, to completely, totally all in hawkish. We have a hawkish Fed. And, we were thinking the Fed might start raising rates in the second half of this year, that they would finish their bond buying program June or July next year, this year. And the roll off of their balance sheet where they let the $8.3 trillion of bonds on it start to mature and not replace them. We thought that would happen maybe in 2 years, maybe longer. Well, now we're expecting a rate increase in March. That's in 2 months. We're expecting the Fed bond buying to be done in March in 2 months. And we're expecting the Fed to start letting bonds roll off probably March or April. That's a triple whammy of hawkishness that it's just like out of nowhere. So even though the markets bounce off their bottom today, we will have rebounds. In bear markets, sometimes your biggest up days, your biggest turnarounds are during bear markets. So that's where we are today. I don't think this is anything over by a long stretch. Goldman Sachs last night came out with a note and said, we see the Fed hiking rates 4 times this year. Jamie Dimon, the great CEO of JP Morgan, said he also sees the Fed raising rates 4 times this year. So if that happens, the shift has changed from a very easy policy, tons of money being pushed into the system, the Federal Reserve flooding the system with liquidity. Eventually, money finds its way into financial assets and esoteric assets. So it goes into stocks, goes into crypto. Now the money starts to come out. It goes into real estate, houses. Mortgage rates are starting to go up, hurting the housing market, slowing down the pace of mortgages. Okay. So, and Wednesday, we get the CPI number, the Consumer Price Index inflation number, and that's expected to be about 7.1%. We thought 6.8% last month was crazy high, but we're going to see in the sevens. Now, this is something that I expect is that as supply chains issue and we get manufacturing semiconductors back on track, these supply chains should ease up. Omicron throws a whole new wrinkle in it. China is super strict with their Omicron policies. So how is this going to affect everything? It's tough to say, but I think it drags things out. I think the Chinese economy is slowing. I think they're riddled with debt. Their real estate developers, which is a key component of their economy, are having a lot of trouble. So I think China, you could basically write them off right now as far as being a near-term engine of growth. Part of that is maybe they don't supply goods as much to the world, but part of that is if their economy slows down, that's a drag on inflation as well. Okay, so these are the things that we are looking at. Okay, I hate when my mic gets all wobbly. It's on a long boom up, so it could tend to bounce around a little bit. So these are some of the things we're looking at. During this morning, the Nasdaq dived beneath its 200 moving day average. These are just like the things that I think are important that I look at in terms of my notes. Okay, and we have Bank Friday. On Friday, we've got earnings coming from J.P. Morgan, Citigroup, and Wells Fargo, and we'll hear what they have to say about the outlook for the first half of 2022. We're going to have a lot of news coming out, and like always, everything's going to be incredibly scrutinized. So, having said all that, are we done with this dip? Okay, I don't have a crystal ball. We could keep going down. We could bounce back up. We could start hitting new highs again. But it seems like the new highs we've been hitting are very short term, just a little pop, and then we go back down. And the longer it takes to reach a new high, the harder it is for stocks to go back to a new high. We are in the process of devaluing tech stocks, which are the biggest part of the S&P 500, which, by the way, is an index. You can't invest directly into an index, but you could invest directly into a security that tracks or mimics the index. So we're moving toward market, or I should say investors want to move toward, it looks like, industrial stocks, energy stocks, financials. So we have new leadership as far as stocks go. But the new leadership is still proportionately a lot smaller than the previous leader, which is tech. This is one time when I wish we had a commercial break so I could really just blow my nose, which I don't want to do on the live stream. So picking through the rubble, let's talk about that and I'll let you go, okay? If you are I'm going to give you the different circumstances. Okay, if you are, my age, I'm 54. If you're my age, younger, a little older, that's okay. And you're just investing every month into a retirement plan. A down market is your friend. This down market doesn't mean you stop investing. It doesn't mean you stop putting money away every month, because this is your friend. The lower it goes, the better off you'll be down the road. If you're looking to buy individual stocks and put them away for the long term, okay, what we're seeing now is really, to me, not that much of a dip. Now, before you go, whoa, Mitch, their stock's down 70, 60, 50%. I'm not talking about meme stocks or a lot of the pandemic winners, the Zooms of the world, the DoorDashes of the world, uh, the reals of the world, the stocks that we talk about all the time here. We had a very unique set of circumstances where people had nothing to do but look at their screens when we were in the heart of the shutdown from the pandemic. And as a result, investors jumped onto these kinds of stocks. They enabled us to work from home, live at home, stay at home. But the valuations went so high. And some of these companies, like Zoom, are still growing. Okay. But it doesn't matter if they're still growing. If you could overpay for price, you could overpay for growth. That's what I meant to say. So these stocks have come down. Do they deserve the rich, or rich is not strong enough of a word, or do they deserve the crazy high valuations? I don't think I could be hyperbolic enough with the language I use. Do they deserve to go back? Probably not. We're not going into another total shutdown. We're not getting trillions and trillions of dollars of government handouts anymore, of stimulus. We're not going through that anymore. So those stocks have come down. But when I say buying now, if those are the stocks you want to buy, they could be okay for a bounce. Could I have to really reinforce I could, or they could not. But what I prefer, if I'm a buy the dip dude, okay, is I'm going to stick to quality. I don't mind buying technology, but I want to buy really good technology stocks. I want to buy the ones that are creating the products that are going to be here for the long term. Like, who's creating the metaverse? Who's creating the chips, the semiconductors for the metaverse? Who's creating the hardware for the metaverse? That's who I want to be in. Let's talk about industrials. If you say, Mitch, I see Honeywell on a dip. If we see a drug stock like Pfizer on a dip, and someone wants to buy that, I'm like, good, you have good taste. That's good stuff. And that, to me, is how you really should focus on the dip. If you're looking to jump back into the meme stocks, if you're looking to jump back into or buy more of the pandemic stocks that have gotten absolutely crushed, again, the Zooms, the DoorDashes, the Airbnbs, Teledoc, I think you're just gambling. You're just basically making a bet on a binary event. Either they bottomed or they didn't. And the thing about a bear market is, when you think something is bottomed, you're wrong. It's much lower than you expect. A lot of these stocks that are still trading $50, $100 a share, you're going to see some of these stocks. I can't say for sure which ones, but based on my experience over 30 years of doing this, of having survived the tech wreck, you're going to see some of these stocks go down to $1. You're going to see, that's right. You could see some of these stocks go down to $1. I've seen this happen before. When you see $100 stock like Lucid, which was the bluest of blue chip tech stocks, and Lucid went down to $1 a share from over 100. You just couldn't believe that. Lucid was up there with respect, the same way that Microsoft and Apple are up there with respect today. So you just couldn't believe it, and it was gut wrenching. So you want to buy the dip, buy it in quality. Don't speculate on a dip on a binary event right away. Maybe you'll see a bounce out of these stocks. If you're looking for trade, you think you could read the charts, they go for it. But most of us If you're looking to just make a quick buck, that's a hard game to play. But if you're looking to buy quality stocks and you want to build a portfolio of quality individual stocks, stick to the quality names. As a branch manager that I had when I was very, very young used to say, make sure it's a company you recognize. It's a company that your parents or your wife would recognize. All right. That's what we need to do. As far as Zoom goes or Peloton, that's a perfect example of how buying something people, Peter Lynch used to say, "Oh, buy what you know." But buying Peloton and Zoom, you got iced. I mean, you just got totally hosed at that. Buying what you know is not some quick, rich, easy peasy way to make money. Okay, you could overpay for value. Micron, one of the great semiconductor chips of today, I don't think it's even still at this point up to the valuation that it had 22 years ago. All right. So that's my story. I'm sticking with it. I'm going to go because I have to really uh, blow my nose and get out of here. I feel like crap. So I'll see you all tomorrow. If you have any questions after the show, hit me up in the comments. I will be there to take a look. And thank you very much for joining me. Peace out.